Hello and welcome to our Chapter 1 overview for Accounting 4. Again, this is Miss Vanderland. So what we're going to be focusing on in this video is really just to do an overview of that first chapter. Keep in mind by the time you get to the lecture videos for each chapter for this class, it's going to be most helpful if you've already read the chapter and at least gone through those PowerPoint slides. Even better if you've already done the Learn Smart, but you can do the Learn Smart assignment either before the lecture video or after. But just make sure you're interacting with the chapter material before you watch a lecture video. That's going to make it just so much more useful. All right, so we're going to dive in here. I'm going to try my best not to make this video too long, but we'll go as long as we need to get through everything here. So with Accounting 4, okay, we're going to be studying managerial accounting. It's an intro to managerial accounting. For most of us, we've recently taken Accounting 2, but for some of us it might have been a while. But for us to get started, it's important to look at just briefly the difference between financial accounting and managerial accounting. So with financial accounting, remember with Accounting 2, if you took that with me, with financial accounting, it was concerned with those external decision makers, right? Reporting information to these external decision makers. And it involved financial reporting, and we learned how to set up financial statements, right? And and even before we learned how to set up financial statements, we learned all about the accounting cycle, right? How to put together those entries and make sense of all that information. And all of that was focused on these external decision makers, right? Which included groups like stockholders, creditors, and investors, right? That's not a complete list, but that's an example of what we looked at in financial accounting. With managerial accounting, the focus is going to be a bit different. Although our knowledge of the accounting cycle and financial statements is crucial for this class, that's going to come along with us, managerial accounting has a different focus. So where financial accounting is focused on those external decision makers, managerial accounting is focused on our internal decision makers, right? It's focused on management, right? Hence the term managerial accounting, okay? So managerial accounting is focused on providing information to managers, okay? So that they can do what? So that they can plan, control, and make decisions, right? Because without information, it's going to be really hard for managers to do their job, right? So that is the big difference between financial and managerial accounting. You are still going to need to know your debits and credits and how to make journal entries and still have knowledge of that accounting cycle in this class. But we're also going to be learning about a lot of other things, but we're going to be applying those journal entry skills in various chapters as well. And if you're a little rusty on that, don't worry about that or freak out. There's always opportunity to kind of brush up on that. We also, have tutors available, so do not worry about that, but just keep in mind you will want to brush up on your accounting cycle skills and knowledge. So a lot of what we'll be doing in this class, it will be focused on cost classification. And there are 5 purposes of cost classification that we'll be focusing on in this class, and actually write these out. I won't be writing out everything when I make these videos, but for this purpose, I'll be writing this out. So the first purpose for cost classification is assigning costs to cost objects. Okay, which we'll get to in a second. The second is accounting for costs in manufacturing companies. And you'll see our main focus through a lot of this course would be on manufacturing companies. That's where a lot of our work will be done, especially with some of the chapters will be focused on manufacturing. Third is preparing financial statements. Fourth is predicting cost behavior in response to changes in activity. And lastly, making decisions. So we're going to be looking at each of these items. So why would we need to classify costs in different ways? These are 5 reasons. The first is to be able to assign costs to different cost objects. We need to be able to account for costs when we're looking at a manufacturing company. When it comes to financial statements, costs have to be classified in a specific way and for us to even be able to begin setting up a financial statement. We also, when we're looking at cost behavior, we need to be able to classify costs into their 3 main categories for this class, which we'll get to in a second. But keep in mind this number 4, if you look on that syllabus, this has everything to do with our SLO, okay? So this is something, this number 4 here, which we'll touch on, you're going to look at this over and over and over again in this class. So just keep that in mind. And making decisions, okay? So we're going to start off with that first one, okay? So we will, this is actually the first learning outcome, but I'll just title this. So for reference, assigning costs to cost objects. Okay. So when it comes to assigning costs to cost objects, there's going to be 2 main categories. Either a cost is going to be direct or it's going to be indirect. Okay. A direct cost is a cost that can be easily and conveniently traced to a unit of product or some other cost object. Okay. So easily and conveniently traced to a unit of product. Okay. In other words, saying I can easily figure out that this specific cost was caused by this unit of product. Okay. The opposite of that would be an indirect cost. If a direct cost is a cost that can be easily traced to a unit of product or a specific cost object, an indirect cost cannot be easily traced. Okay, cannot be easily traced. Okay, so what would be some examples of this? Well, with a direct cost, when it comes to, let's say, the wood that is used to manufacture a table, I can easily figure out, okay, this is how much wood was used to make that table. That is easily traceable to that one unit of product, that one table, the cost of that wood. That would be a direct material. Or if I look, I can figure out how many hours my factory worker spent on constructing that table, right? That's direct labor. I can easily figure out how many hours it took them or how many hours they worked on that table, right? That cost of that labor is direct in that sense because I can easily trace it to that one table or that one unit of product. But indirect costs, they're really not so easy to trace to a unit of product. Let's assume we're talking about that same table, right? That same table that's being manufactured. The labor, at least the direct labor, can be easily traced, right? The wood, right, which would be a direct material, can easily be traced. But what about, because we're assuming this is being made in a factory, right? So what about, that's my best attempt at drawing a light bulb. What about the cost of heating and lighting that factory as a whole, right? What about the cost for janitorial services, for example, right? All of those things are costs that are incurred to keep that factory going, but it's going to be really hard to figure out what percentage or what portion, for example, of that electric bill this table is responsible for. right? So in that sense, we would refer to that as an indirect cost, not a direct cost, because we can't easily and conveniently trace it to that table. If we wanted to even get close to making an estimation, it's going to take so much time that it's not worth it to go about making those kinds of calculations. So that's the difference between a direct cost and an indirect cost. Okay, and a cost object, just to be clear, is whatever we're looking at that is causing a cost to occur. Okay, so a cost is direct if I can easily trace it to a cost object, like a unit of product, but a cost is indirect if I cannot easily trace it, right? Like the electricity bill or depreciation, factory depreciation and items like that. So a third item we're going to look at, which is common costs. Common costs are just a type of indirect cost, okay? But what makes common costs different is they are incurred to support a bunch of different cost objects at a time, okay? So costs incurred to support many cost objects, okay? And obviously, because they're being incurred to support so many different cost objects, they can't be traced to any one unit of product or any one cost object for that reason. A common cost, for example, would be, let's say, the CEO's salary, for example. Okay, so that is our first cost classification purpose, right? Assigning cost to cost objects, where we've broken down cost between direct and indirect, right? And the thing that differentiates a direct and indirect cost is how traceable that cost is to a unit of product. Okay, so our second cost classification purpose is accounting for costs in manufacturing companies, right? Accounting for costs in manufacturing companies. Okay, so when it comes to manufacturing companies, we have to break down costs into three main categories. Okay, and this is going to kind of become the foundation for a lot that we'll be talking about later on in this class. Okay, so when it comes to manufacturing companies, there are three main manufacturing costs. Okay, these manufacturing costs is basically, what is manufacturing cost? It's just the cost of making whatever it is the company makes or whatever they specialize in, right? The cost of manufacturing their product or line of products. So there are three different types of manufacturing costs. There's direct materials, right? Those materials that go directly into producing that product, right? They can easily be traced to a unit of product. Direct labor, which is those labor costs that can be easily and conveniently traced to a unit of product. Okay, so these are the traceable costs. But then what about the stuff that isn't really easily traceable, right, to a unit of product? That's what we'll call manufacturing overhead. The easy definition for that is, well, if direct materials and direct labor is the material and labor costs that are easily traceable to a unit of product, manufacturing overhead is just everything else. In other words, if direct materials and direct labor are their own category, and this third category is everything else, this is basically your indirect materials, right? Those materials I can't easily trace to a unit product, or my indirect labor. Okay, indirect materials, for example, let's assume you're a factory that uses a lot of machinery. If you're using lubricant, for example, to help maintain those machines, you can't really trace the cost of that lubricant to one specific unit of product. At least you can't do that easily or practically, right? So it would be seen as an indirect material. Is it a necessary cost to keep everything going? Of course, but it's not a direct material. Same with indirect labor. For example, what about the cleaning team at a manufacturing plant, right? Is that a necessary cost? Of course. But that might be a little bit more impractical to try and trace to a specific unit of product. It's not going directly into a product. It's just a supporting cost. Okay? So keep in mind you have direct materials, direct labor, and then everything else, which we call manufacturing overhead, which is your indirect cost, your indirect materials, and your indirect labor. Okay, so some other examples of manufacturing overhead would be depreciation on those machines and different items within the factory, depreciation on the actual uh, building itself even. We talked about utility costs, right? The cost of heating and maintaining and lighting a plant like that. Property taxes, right? If property taxes need to be paid, it's a necessary cost, but it's probably not so practical to try and trace a specific percentage of those taxes to any one unit of product. Okay. And another one also, as an example, would be insurance premiums. So those are just some examples of manufacturing overhead. Okay. So again, everything that we've looked at right now are manufacturing costs, the costs that are necessary to produce a unit of product, right? The direct materials and direct labor are those items that can be directly traced to a unit of product. And everything else, right? Can we argue that utility costs are necessary? Depreciation cost is a necessary cost that shows up on the books? Of course, right? We can't avoid these things. They're still involved with manufacturing in general, but they're not directly traceable to that unit of product. So I'm going to draw a little table here. Okay, so you have direct materials, direct labor, and manufacturing overhead. And we're going to be using shortened versions of this basically, which are as follows. I'll use DM, DL, and manufacturing overhead in this class. So we said direct materials and direct labor are those costs that go directly into the product. We can easily trace them, right? These two taken together, right? Direct materials plus direct labor equals what we will call our prime cost. Okay. But direct labor and manufacturing overhead, if you add those two together, we can argue that, well, if you have your materials, that's one thing, but we actually have to employ labor and other elements to actually put those elements together and construct them and actually produce a finished product. Okay, so that's why, well, direct materials and direct labor, it's those prime elements that go into the product, right? But really, it's direct labor and everything else that converts that product into its finished form. So direct labor plus manufacturing overhead is what we refer to as conversion costs or conversion cost. Okay, so the shortened version of this, you want to write this down. You're going to need this. Direct materials plus direct labor equals prime cost. But at the same time, direct labor plus manufacturing overhead is going to equal my conversion cost. Okay, so everything we've just talked about refers to manufacturing costs. But what about non-manufacturing costs? Those costs not involved with the actual manufacturing of a product. Okay, well, non-manufacturing costs, we have selling costs in general and administrative costs. Okay, from financial accounting, this is what we refer to as SAG expenses or selling, administrative, and general costs. So selling costs is basically all the costs that go into securing orders and delivering the product to the customer. Okay, these can be direct or indirect as well. And administrative costs are any executive, organizational, and clerical costs that a company incurs, right? Like the salary of those working at the head office, right? Any kind of clerical positions, okay? Secretary salaries, and so on and so forth, okay? And we'll a bit later on this video, we'll briefly touch on how these are treated differently than manufacturing costs when it comes to financial statements and financial reporting. Okay, so that gets us to our third cost classification purpose, Okay, we need to be able to understand cost classifications in order to prepare financial statements, something we did in financial accounting. Okay, we can't quite get away from financial statements in managerial accounting. Okay, so when it comes to preparing financial statements, we need to be able to make a classification between product costs and period costs. Okay, so product costs are those costs all those costs involved with making a product, right? Like we looked at, like direct materials, direct labor, and manufacturing overhead. All of those are product costs. Okay, and to conceptually look at this, you want to think of product costs as attaching to a unit of product. Okay, because until a product is sold, its costs, if a product is still sitting in inventory, its costs are sitting in inventory, and it's considered an asset until it is sold. Okay, so this is going to sit in that inventory account until we actually make a sale. Okay, so product costs, they're going to include three main categories. They're going to include raw materials, work in process, and finished goods. So all three of these are inventory accounts. They just represent inventory costs at different stages of the manufacturing process. Okay, so these are all asset accounts, because remember, inventory is an asset. Again, product costs are manufacturing costs. So raw materials, that's just any material, whether it's direct or indirect materials, any material that goes into the final product. Okay. Work in process, that is going to consist of units of product that aren't necessarily complete yet. Again, they're in process, and they need further work in order to be completed. Okay, so work in process, as soon as you use raw materials, it's going to be moved into work in process. Okay, as soon as it's actually employed in production, but it's also going to include direct labor and manufacturing overhead, because remember, these two items are needed to convert that product into a finished good. Okay, and finished goods, that is going to consist of completed units. They just haven't been sold yet. All the work has been done on these units. So finished goods, when you look at that account, the cost you see in that account is just going to refer to the cost of the completed units as of that up until that point of time. They just haven't been sold yet. Okay, so costs are going to move to and from these different accounts as we incur more costs and as we move through that manufacturing process. Okay, so raw materials. Okay, we'll have raw materials sitting in inventory, right? Raw materials is whether those indirect or direct materials that I'm going to use to make my products, right? So let's assume I decide to use some raw material to start work on a product, right? Then it's going to be credited. I credit raw materials for that amount. And where do you think it's going to move? It's going to move to my work in process account then instead, right? Because now I've used those raw materials and now they're in process. So that becomes part of the work in process account. Okay. And same with direct labor and manufacturing overhead costs. Okay, they are also added to work in process to help convert those items to finished goods. Okay, and once a unit of product or a group of products is actually finished, let's say there's a portion of our work in process that is actually completed. If it's complete, it's no longer in process, so it needs to then, oopsies, it needs to then move from work in process to our finished goods account. So in that case, you would credit work in process and then debit finished goods. You're moving it to that asset account for finished goods. But we don't have to get into too much detail. I already went a bit too far by even drawing out these T accounts, but we're definitely going to be jumping into that later on in the class. But let's just go one step further since I already came to this point. Now, finished goods they're finished, right? They're items that are ready to be sold. Now, what happens when they're sold? Well, let's say I sell everything in this finished goods account. I have to credit that account. Then what might be debited? Cost of goods sold then. Then it moves from being an asset on the balance sheet to being a cost on the income statement. Okay? So again, product costs, they're going to include direct materials, direct labor, and manufacturing overhead. Okay? And period costs is actually going to involve your selling and administrative costs. Okay? So I'll actually just do a more summarized version of what I showed you up there. So remember, we looked at 3 different types of inventory accounts depending on their stage in the manufacturing process: raw materials, work in process, and finished goods. Okay? But basically, those costs sit in inventory on the balance sheet, right? What causes those costs to be converted or moved over to the income statement onto cost of goods sold? What's that condition? A sale has to be made. As soon as I sell an item in a finished goods account, it moves from finished goods into cost of goods sold, and it has now moved from the balance sheet onto the income statement. Okay, that's how product costs work. But period costs, those are not manufacturing costs. These are selling and administrative costs. Okay, these are expensed in the period in which they are incurred. Okay, expensed when incurred. Okay, so product costs are expensed to cost of goods sold as soon as a product is actually sold, right? But before that product is sold, those costs of making a product are sitting in inventory on the balance sheet. They are inventoried or inventoriable costs. Okay, but period costs, selling and administrative costs, those don't sit in inventory because they don't have anything to do with the manufacturing process. So they are expensed when incurred. So they will directly be put into the expense account that is relevant to that specific cost. So they directly and immediately go to the income statement. Okay, so period costs are expensed when incurred, where product costs are inventoried until that product is sold and it moves to cost of goods sold. Okay, and it's important that you make sure that you, as we work through chapter 1 and we get to our Zoom meeting, that you ask any and all questions that you need to ask, because chapter 1 forms the foundation of everything else. You need to have a really good grasp of chapter 1 in order for the following chapters to be a little bit more easy to understand. Chapter 1 is very important. All right. And the next purpose of cost classification is to help us predict cost behavior. Okay? And again, this refers to our student learning outcome, or SLO, that you'll find on the syllabus. Okay? So what is cost behavior? Cost behavior refers to how a cost reacts to changes in activity. Okay? So depending on what kind of cost we're looking at, we can expect it to behave a certain way when activity either goes up or down. Now for our class, we're going to look at the 3 most common cost classifications, right? And that's going to be a cost is either going to be seen as variable, fixed, or mixed, okay? A variable cost, okay? This kind of cost varies in total in direct proportion to changes in the level of activity. Okay, so varies in total, okay, I don't want that to look like the word indirect. In direct proportion to changes in activity. Okay, and I'll move these 2 down. Okay, so in other words, a variable cost in total, if activity goes up, what can we expect the variable cost to do? We can expect that variable cost to go up in direct proportion. Same if activity goes down, we can expect that variable cost to go down in direct proportion with that change in activity. Okay, we'll look at that in more detail in a second when I set up a table. So what causes variable costs to either go up or down, right? That is what we would call an activity base, or our cost driver, the thing that's driving or causing that variable cost to be incurred. Okay, it causes the incurrence of variable costs. So some common activity bases or cost drivers, in other words, that will be applicable to this class is units produced. For example, as I make more units of product, guess what? The cost of direct materials and direct labor should be expected to go up as well, right? Direct materials and direct labor in general would be considered to be variable costs because as the units produced go up, we expect those costs to go up in direct proportion or somewhat proportionately. Machine hours is another one, okay? For example, as I use more machine hours, I can expect to spend more on electricity costs, right? Miles driven is another example. And labor hours. Okay, just some examples of some cost drivers, those things that cause certain variable costs to actually be incurred. So that's a variable cost, right? So how does a variable cost differ from a fixed cost? Well, the name of the cost helps us to figure that out, okay? A fixed cost is gonna remain constant in total, that's the key word, as activity changes. Okay, so an example would be the rent on the factory building, right? I might make 1 unit of product that month, or I might make 1,000 units of product that month. Doesn't matter because I'm still going to have to pay my rent, right? Rent is not going to go up or down depending on how many units of product I make, okay? At least within that context, because we're going to talk about the relevant range in a second, okay? So in total, fixed costs like rent are going to stay the same. But if we're talking about a fixed cost on a per unit basis, okay, then that's a little bit different. Then a fixed cost per unit varies inversely as activity changes. Okay, and how is this possible? Well, let's assume our rent is $1,000 a month, okay, to rent that factory space. That's not going to change, okay? However I wish to choose to use that that factory, I'm still going to pay $1,000 a month whether I make 1 unit or 1,000 units of product, okay? So let's say I make 1,000 units, okay? What is my cost of rent per unit? What's that fixed cost of rent per unit if I make 1,000 units? Well, 1,000 divided by 1,000, right? That comes out to $1 of rent cost per unit of product, right? Basically, I spread out that rent cost of $1,000 amongst 1,000 units of production, okay? But let's say for some reason that month, I only made 1 unit of product. How much did you pay in rent to make 1 unit of product then? What's our fixed cost or our rent cost per unit? In this case, it's $1,000 per unit, right? In this case, we divided that rent cost of $1,000 only amongst 1 unit of product. We weren't very productive, right? So that 1 unit of product cost us $1,000 in rent. Whereas when we use that space to make 1,000 units, you're spreading out that fixed cost amongst more units, making it the rent cost per unit a lot cheaper, right? In this case, when you use that space more effectively to make 1,000 units, each unit of product in that case only costs $1 in rent. So that's why we're saying fixed costs in total, in terms of $1,000, that stays the same whether activity goes up or down. But per unit, it varies inversely. As activity goes up, let's in this case to 1,000, the cost per unit goes down. Whereas when your activity level goes down, the cost per unit goes up. Okay, so you see how that has an inverse relationship there. Okay. And there are different kinds of fixed costs. You either have committed fixed costs or you have discretionary fixed costs. Committed fixed costs are more long-term, and they can't really be significantly reduced in the short term. Like, for example, your rental contract or your insurance contract. Those would be examples of committed fixed costs. The manager can't decide all of a sudden, okay, I want to pay less for rent or less on my insurance premiums. If there's a contract in place, you're not really going to be able to do much about that committed fixed cost in the short term. Discretionary fixed costs, though, they may be altered in the short term with certain managerial decisions, right? So if there's maybe something that is not based on a contract, right? Or we decide, you know what, our utility costs are a little bit too high. What can we do in the short term to bring that down next month? That would be seen as more of a discretionary fixed cost. Maybe we can renegotiate that contract, right? It really just depends on the situation. Some costs are discretionary, some fixed costs are committed, depending on if there's a contract involved or what kind of costs we're really looking at. Okay, so these rules for how fixed and variable costs behave really is relevant only or applies only to the relevant range. Okay, relevant range of activity. Okay, so the relevant range is basically a range of activity at which certain cost behaviors apply. So, for example, we talked about the $1,000 of rent, right, to rent a space. So let's assume that's for one building, and that building is limited in its square footage, right? So we can say, okay, this fixed cost stays the same in total of $1,000, and it varies inversely as activity changes, sure. But what happens when you have to rent a second building because you're making more and more product and you need to expand? What's going to happen to that fixed cost of $1,000? Is it now, in that case, when you're now renting two buildings, is my rent going to stay the same in total, that fixed cost? No, now we bump to a different relevant range, right? A larger amount of square feet, right? And let's say that second building is also $1,000. Then all of a sudden your fixed cost of rent has bumped to $2,000 a month. Okay, so you can only talk about fixed costs and variable costs behaving a certain way within a relevant range of activity. From an accounting perspective, if we look at a graph that compares activity and total cost, keep in mind we expect as activity goes up, total cost to go up in general, right? From an economist's perspective, really it has more of a curvilinear nature to it, right? But from an accountant's perspective, we just make an assumption of a straight line. We make an approximation of a straight line. Let's see if I can actually get this. It's already a little bit lopsided. Okay, I'm just going to do my best here. So this is where we get our relevant range concept from. That portion of the curve is relatively straight. So from an accountant's perspective, to simplify things, we just make an assumption that that part of the graph is actually straight and not curved. Now keep in mind, if I want to graph just a fixed cost, it's a flat graph because it's fixed within a relevant range of activity, right? But remember what happens, because only part of that graph might look like this until we go outside of that relevant range of activity. For example, I need to rent more space. All of a sudden that fixed cost has jumped up and up, right? As square feet requirements go up, that fixed cost of rent is going to increase, and the relevant range that is now applicable changes. Okay, so that applies to both fixed and variable costs. Okay, at some point in time, if your activity goes beyond that relevant range, you're going to have to spend more, and these costs are going to change. But in essence, at the basic foundation of these cost behaviors, the rules apply that we talked about. And I'm going to just keep in mind, so if this is our fixed cost, just in general, this is what a fixed cost looks like graphically. And a variable cost is going to be a straight line. But guess what? When you put fixed and variable costs together, we have something called total cost or mixed cost, right? And when we combine those two graphs, the graph has to start at the y-intercept, which is our fixed cost amount, and then it goes up from there to represent the variable portion of that. So these two graphs taken together give us this total cost or mixed cost graph. So one thing that we're going to be tested on throughout this class over and over again is our cost behavior table. Okay, so we have variable cost and fixed cost. I'm going to try my best to make this look somewhat neat. It's a little bit more difficult when it's digital. So we actually move this guy down, or attempt to. No, that's not going to work. That's all right. We'll work with what we have. So in this column, I'm going to look at in total, and here per unit. Variable costs, what do they do in total again? Okay, in total, they vary proportionately as activity changes. Okay, so as activity goes up, what can I expect variable cost to do? Go up. As activity goes down, what can I expect variable cost to do? Go down. So as activity goes up, variable costs go up. As activity goes down, variable costs go down. Per unit, though, variable costs stay the same. For example, the per gallon cost of gas, right? If you go and fill up your car, as you fill more gallons of gas, the total cost is going to go up, right? But per unit, as you're filling up your car with more and more gallons of gas, that gallons being the activity, is the price per gallon at that moment in time of that transaction changing? No, the per unit cost of that of 1 gallon of gas is staying the same. But what about fixed costs in total? Remember, they stay the same. But they stay the same what? Stay the same with all of this is within the relevant range of activity. And what about fixed cost per unit? Okay, fixed costs per unit vary inversely as activity changes. So as activity goes up, the fixed cost per unit goes down, but as activity goes down, the fixed cost per unit we can expect to go up. Okay? And keep in mind that a mixed cost is just a mixture of variable and fixed elements. Okay? So both variable and fixed. So another word for mixed cost is total cost. Okay, so we're going to look at this example of total utility cost. Okay, so I'm going to have total utility cost on the left and that activity as my x-axis, which is, for this purpose, it's going to be kilowatt hours. Okay, so if we're looking at your total utility bill, in this case, for example, we're going to say that part of that bill every month has a fixed element to it, a monthly utility charge. But then we're being charged a certain amount per kilowatt hour. Okay, so we're being charged a monthly amount, but also per kilowatt. So this line right here is really your total utility cost, mixture between the fixed element and the variable element. Okay, so that line, or this graph right here can be expressed as an equation. And the equation we're going to use in this class is y equals a plus bx. It's basically the equation of a linear line. Okay? Y, this is your total mixed cost, or in other words, your total cost. Okay? A is your total fixed cost. B is your variable cost per unit. And X is your activity level. So let's put this to use here. So let's assume the monthly charge on our utility bill every month is $40. Okay, $40 a month. And let's assume the variable cost of my utility bill is 3 cents per kilowatt hour. Okay, so for this example, let's say we used 2,000 kilowatt hours. Okay, what is my total bill? Okay, because my bill is mixed up of both fixed elements and variable elements. Okay, let's put it together then. Because remember, our equation of a line is y equals a plus bx. Y is my total mixed cost. That's what we're trying to find, right? We don't know y. But do we know A, our fixed cost? Yes, we said every month we're charged $40. Do I know B, my variable cost per unit? Yes, I'm charged 3 cents per kilowatt hour. Do I know X, my activity level? In other words, in this case, my activity level is number of kilowatt hours. Well, it says we used 2,000 kilowatt hours that month. Can I now figure out Y, which is my total mixed cost or my total cost? Yes, I can. We're going to do 3 cents times 2,000 kilowatt hours. Okay, so that should come out to $60, I believe. Add 40, and we get $100. So that's my total bill, is $100. But this $100 bill, utility bill, is made up of both variable and fixed elements, right? And graphically, that's what that would look like. Okay? So we're going to be using this a lot in this class, but this is the basic idea behind cost behavior. Okay, so we're going to move on to another cost classification purpose. Cost classification is also important for making decisions. Okay, so in order to make decisions, it's important for us to be able to determine what is relevant and what is irrelevant, right? There are some relevant costs to consider when making a decision and some irrelevant costs. Okay? Ultimately, when we make decisions, it involves choosing between alternatives, alternative choices, options, right? But when I'm choosing between two different options, it's important to decide, okay, what about the information that I have is relevant and what is irrelevant? I want to make sure to ignore the irrelevant costs so I don't make a convoluted decision, right? Don't make the wrong decision or a poorly informed decision. Okay, so it's important to know what kind of cost information is important for me to focus on so I can make better decisions as a manager. Because in this class, we're going to be looking at everything from a managerial perspective. Okay, so let's say you have two choices. As a manager, you're getting to choose a new investment project, a new project for your division, right? Well, you have two alternatives, right? Well, each alternative is going to cost something. Investments usually cost money, right? So the difference between the cost of alternative A versus alternative B is what we will refer to as our differential costs, right? Another word for that is incremental. Okay, so the difference between the cost of investment A versus investment B, let's say investment A costs 100 and investment B costs 110, then the differential cost in that case is $10. But also with any kind of project, the intention isn't just to spend money, right? The intention is to make money. So it's not just the cost that we would look at when trying to make a decision between two project choices or options. We also want to look at what kind of money is going to be coming in, right? Let's say, oh, the revenue that we expect to come from project A is $200, and the revenue that we expect to come from project B is $150, right? Well, that's also relevant, right? That's an important factor. The difference between the revenue we can expect from project A versus project B, that is what we would refer to as differential revenue. In this case, the differential revenue is $50. We expect to generate $50 more in revenue by going with project A versus project B. Okay? So just keep in mind from a manager's perspective, in this kind of situation, you want to look at what's the difference in cost and the difference in revenue between these different alternatives, right? In this case, the differential cost and revenue, that's all relevant cost information. That's going to help me to make a decision as a manager, okay? But when making decisions, another important cost to try and identify is opportunity cost. This is something that if you've taken economics, you've seen this before. Opportunity cost is basically that which you give up to get something else, basically. Okay? It's that potential benefit or that thing that you give up to get something else, right? When you choose one thing over another, right? So I'll just write that out here. That which you give up to get something else. This is not something you're going to find in the accounting records, right? This is not quantitative, right? This is qualitative in nature, okay? You can't really, it's not always going to be very easy to put a specific dollar amount on opportunity cost, right? You can, obviously, but it has a lot of qualitative elements to it, okay? So, for example, we can say, what's the opportunity cost of attending class? Well, more quantitatively speaking, you can say, well, I could have worked another 2 hours at my shift, so I'm really giving up $20 in wages to be here, right? But if we switch that, what if you decided to go to work instead of attending class? What's the opportunity cost then? What are you giving up to go to work? You're giving up, let's say, extra learned knowledge, right? Getting ahead in class, right? So you can look at it either way. Opportunity cost, although you can't go and search it up in the accounting records, it's important to identify opportunity costs because it's not just, oh, I'm only going to look at accounting record information, right, to help me make a decision. There are some other elements that we also consider to help us make good decisions. So opportunity cost is also a relevant cost item. But then there are some things called sunk costs. Sunk costs we can't do anything about. Okay? Sunk costs have already been incurred. Okay? And can't be changed. So if I can't change this cost, it's already occurred, there's nothing I can do about it, does it make logical sense to make it part of my decision-making process? No. Sunk costs are irrelevant costs and should be ignored when it comes to making decisions. Okay, so I'll give you guys kind of a non-accounting example, but this tends to get the point across. Let's say you buy let's say 3-day pass to Disneyland. We all know those things are really expensive. But let's say 2 hours into your first day, you get the stomach flu and you're sick and you have to stay in the hotel all weekend long. Can you go and get a refund for that 3-day pass at Disneyland? No, you can't. It's a sunk cost. You can't recover that cost, right? Just because you got sick. Although we would be very upset in that moment that we lost that money because we got sick and we're upset about it. Does it make logical sense for that to derail everything, for example, and affect all the decisions we make after the fact? Not necessarily, right? In that case, an unused ticket or a group of tickets would be considered a sunk cost if we can't use them. Okay, so that's just kind of a Disney example that tends to get the point across for people, but just keep in mind that a sunk cost is something that has already been incurred. I can't do anything about it, and it should be ignored for the purposes of decision making. Okay, and then we're on to our last point is preparing income statements for a merchandising company. This point is added into chapter 1 just as a little preview, really, of what we'll be doing later on, okay? But those different kinds of cost classifications that we looked at will be applicable to the different ways of setting up an income statement. So we have the traditional format, which we are all familiar with and we should refamiliarize ourselves with from accounting 2. The traditional format, and I'll kind of jog your guys' memory here of the income statement, is we start out with listing sales, okay? And then what do we subtract from sales? Cost of goods sold. Sales minus cost of goods sold gives us what? What item does that give us? It gives us gross margin or gross profit, okay? And then after I've subtracted my cost of goods sold, I subtract my selling and administrative expenses, okay? And then I am left with my net operating income. In this class, we're not often going to go all the way down to net income because to get to net income, you need to subtract some other cost items. But just know that once you subtract your selling and administrative expenses, that gives you your operating income, the income arising strictly from operations. Now, if this is like, what the heck did we just do? I don't remember that at all. That is a cue to go back and familiarize yourself with the setup of a merchandising income statement, okay? Because trust me, a lot of you might not listen to me, right? But down the line, you're going to be like, gosh, I wish I had spent a little bit more time to refresh on those items. This is going to come up again and again. And it's important for you to be very comfortable with this setup of an income statement for later on as we get down the line, okay? We're going to be working with this traditional format, but we're also going to be working with our contribution format income statement. Now keep in mind, what kind of cost classifications are important for helping us to set up the income statement this way? The classification between product costs and period costs, right? Period costs are those SAG expenses, and product costs are those items that are inventoried and don't show up on the income statement until they are sold, right? Showing up under cost of goods sold. But the contribution format income statement, what cost classification applies to this? This format compares or separates variable versus fixed cost elements. Okay? This is where you list sales first. That's always going to be first. That doesn't change, right? But with a contribution format income statement, we're separating costs based on their cost behavior, whether it's variable or fixed. So you start with sales, and then you first subtract out all things variable, all those variable expenses. Sales minus variable expenses equal contribution margin. This is a new term that most of us haven't seen before. Contribution margin is basically what amount of sales is left over after subtracting out your variable expenses. Or in other words, how much money do I have left to cover those fixed costs? So after you have your contribution margin, you subtract out any and all fixed expenses. And then after I subtract out my fixed expenses, I'm left with my net operating income. Okay, this is going to come up in chapter 5, 6, 8, later on, okay? Although we're not in chapter 5 yet, and chapter 6 actually we use this a lot. Although we haven't gotten to those later chapters, I'm giving you guys a gentle little hint at this point in time, and what I just wrote down over here, the basic concepts behind it. You want to make a note of it and go back to it. Make sure you understand at least the basic idea of what I was trying to communicate here. Okay, the traditional format breaks up period versus product costs, right? And product costs, again, they show up on the balance sheet, but as soon as a unit is sold, it goes from being a product cost and moves over to the cost of goods sold account. Period costs are expensed right away. Okay, so it's not until a product is sold that its cost shows up on the income statement. But if I'm setting up an income statement using the contribution format, which is more for managerial purposes, okay, if I'm setting up an income statement this way, I'm breaking up costs between variable and fixed based on how they behave, whether it's in a variable fashion or in a fixed fashion. Okay, we'll get into more detail, but you might just make note of this, write it down somewhere, make it clear the difference between these two formats so that by the time we get into diving deep into this, you'll be a little bit better prepared. Okay, so that's it for our overview of chapter 1. We'll be meeting soon over Zoom to look at this as a class, but I just want to remind everyone that for this class, before you get to a Zoom meeting, whether you choose to go to the Tuesday or the Wednesday meeting, although, again, let me just be clear, our first week looks different. We're going to be meeting on Monday and Wednesday, but before you come to any Zoom meeting in this class, it is expected that you've read the chapter, okay, and that you've watched the lecture video that I provide to you and you've gone through those PowerPoint slides. Because it's going to be so much more helpful when you get to our Zoom class and you can actually ask pointed questions and actually get help, right? How are you going to know what you need help with? Or how is it going to help I go through problems if you haven't even touched the chapter? Then it's just going to be a waste of time. So really heed my advice. Make sure that before you get to your Zoom meetings that you have already gone through the material so that when we get to practice problems that you can follow along a little bit better and you know what questions to ask. Okay? So also keep in mind there's a bunch of practice opportunities in each chapter. You have your guided practice, you have your foundational 15, and you also have the practice exam, which we will be going over as well. Okay, so good luck with chapter 1, and we'll be talking soon.